Hello all. In this video, we're going to have a look at IAS 7, focusing on the statement of cash flows. So first and foremost then, what is a cash flow statement? So this is essentially a statement of information which will detail an entity's overall view of money flowing both into and out of the organisation during a specific accounting period. Any information in the cash flow forecast will be directly extracted from the statement of profit or loss and financial position. So why is a cash flow statement important then? So it can help an entity to identify any issues that they may have. It illustrates where cash is being made, as well as where cash may well be being lost. It can act as a decision-making tool, because ultimately it allows for detailed assessment. Rather than just relying on profit, it is factual. This makes it not as subjective and also more accurate. Liquidity and solvency can be assessed using the statement of cash flow, and it can actually help to predict future cash flows that may be coming up. So a few definitions then. Firstly, we have cash. So this comprises cash on hand and on-demand deposits. This does include bank overdrafts. We then have cash equivalents. So these are short-term, they are highly liquid investments, and they are going to be readily convertible to known amounts of cash, and they are subject to an insignificant risk of change in value. So a good example of this would be a short-term government bond. We then have operating activities. So these are essentially activities which produce revenue. They are activities which do not include investing, and they do not include financing the business. Investing activities then. So this is all about the acquisition and disposal of long-term assets and other investments which are not included in cash equivalents. And finally, we have financing activities. So these are activities which are going to result in the changes in the size and the composition of the contributed equity and borrowings of an entity. So there is a standard pro forma then when looking at the cash flow forecast, which is made up of the operating activities, our investing activities, and then our financing activities. So we will firstly have a look at cash flows from operating activities. So this is cash generated from operations. It is going to look at tax paid as well as interest paid. And it can be calculated using the indirect or the direct method. The indirect method tends to be more popular. So the indirect method then, what is it? Well, it's a reconciliation from the profit before tax figure. And essentially, it's going to calculate the cash generated from operations. So when using this, then there are a few steps that are required. So firstly, you need to be able to access the statement of profit or loss in order to obtain the profit before tax figure. You then must adjust that for the non-cash items. Once you've done that, you can convert the income and expenses figure from the accruals to the cash basis. This results in just the cash flows from operating activities being left. So, to arrive at the cash generated from operations using the indirect method, this is how you would calculate it. And we will have a look at these in a little bit more detail in a moment. So taking your profit before tax figure, you would adjust it by adding back any depreciation, any amortization, and any impairments. You would deduct any profits on disposals, whilst also adding back any losses on disposals. Any interest receivable or any investment incomes you must also deduct. And any finance costs we add back. That will then give us our operating profit figure before our working capital changes. So in order to arrive at the cash generated from operations figure, we need to have a look at the working capital movements. So if it is an increase in inventory, we need to deduct it, whilst a decrease, we would add it back. Likewise with receivables. Contrary, our trade payables, we would do the opposite. So if our trade payables increase, we add them back, and if they decrease, we deduct them. So let's have a look at depreciation and amortization then. So capital expenditure purchases and disposals are going to be recorded under investing activities. However, depreciation is simply just the writing off of capital expenditure over useful life and is just an accounting entry. This means we need to add it back to our profit figure as it was previously deducted from the profit as a non-cash expense. Profit or loss on disposal then. So cash inflows, so we're looking at sale proceeds here, are going to be recorded under investing activities. It is calculated by comparing the carrying amount and the proceeds, and then we would be recording in the statement of profit or loss. Thus, it is important that we remove this from cash generated from operations. A loss on disposal is going to be added back as it is a non-cash expense deducted from our profit figure. And on the other hand, if it is a profit on disposal, it needs to be deducted from the profit because it is a non-cash reduction. Interest receivable then and investment income. This is not considered a part of day-to-day operations. The statement of profit and loss amount should be deducted from the profit because the amount may not be exact as it is going to be prepared on an accruals basis. Finance costs. So these are also not considered to be a part of a day-to-day operation of a business. It is an expense from the statement of profit or loss, and we need to add these to the profits as this amount is not necessarily going to be the correct amount that was or is going to be paid. Changes in receivables then. So if our receivables increase, this is going to equate to a reduction in our cash. And a decrease is going to equate to an increase in cash. Similarly with inventory, so an increase is going to equate to a cash reduction, whilst a decrease is going to equate to an increase in cash. Contrary, changes in payables then. So if these increase, it's going to mean that our cash is going to increase. But if they decrease, it means our cash will also decrease. So that was the indirect method. We are now going to have a look at the direct method. This one isn't as commonly used, but it can be if you want it to be. So for this, it is simply just a case of adding cash inflows and deducting cash outflows in respect of operating activities. So we would take our cash receipts from our customers, add that back as well as our cash receipts from other operational suppliers, but we would then deduct any cash payments to suppliers, cash payments to employees, and cash payments for expenses. That would then give us the cash amount generated from operations. So, although the indirect method tends to be more commonly used, IAS 7 actually encourages the use of the direct method. So the indirect method enables the reconciliation to highlight that profit and cash are not equal. It shows that significant elements of trade and cash flows are not shown, and preparing the information is going to be at a very low cost. The direct method, information is disclosed that is not going to be shown elsewhere in the financial statements. Cash flows from trading are going to be shown, and it is going to help decision makers as they can estimate future cash flows better because ultimately it is more accurate. So, operating activity cash flows could include the following: interest paid and income tax paid. So, if you're asked to calculate interest payable for the cash flow, you need to be aware of how to do that. So, if we think about it, interest payable in itself is a debit account. It is an expense. So our balance brought down will go on the credit side, whilst our profit or loss figure would also go to the credit side. On the debit side, we would then have our balance carried forward into the next period, and the bank figure is the figure that you may need to be able to work out, which is also going to be a debit in the interest payable account. Cash flows from investing activities then. So we have interest received and dividends received, as well as disposal proceeds and the acquisition of non-current assets. So we've got interest and dividends received then. So for both of these, you can use the same pro forma. They are both credit accounts. It is income coming in. So our balance brought down from the previous period is going to be on the debit side, whilst we're going to have the balance carried forward to the next period in the credit side of the account. Our profit or loss would also be on the debit because it's money coming in. And on the left, we would have our bank account. Cash paid to acquire non-current assets then. So non-current assets, a carrying amount, we can work this out also with a T account, using our balance brought down being on the debit side, whilst our balance carried down is on the credit side, alongside the depreciation for the year and the carrying amount of disposals. This then means that if you do have a revaluation and you are trying to work out the carrying amount of a non-current asset, you need to include that revaluation gain for the year on the debit side. Any additions of non-current assets would also go to the debit side of the account. Cash received on the disposal of non-current assets. So again, using the T account, you would have your cost of the non-current asset on the debit side, how much you actually paid for it, and you would offset that against your accumulated depreciation, putting that on the credit side for the amount of time that you have owned that asset. If you have a profit on disposal, that would also go on the debit, whilst the loss on disposal belongs on the credit side. We can then find a balancing figure with the bank, putting that to the credit side as well. Cash flows from financing activities then. These include share proceeds, loan and debenture proceeds, repayments of loans, and dividends paid. So proceeds from new share issues then. So this is looking at your share capital and your share premium account. So any balance brought down on any of those accounts are going to go into the credit side, whilst your balance carried down into the next period is going to be on the debit. If you do have any new shares issued during that financial period, that is also going to belong on the credit side, because ultimately it's being received. It's technically income. Proceeds and repayments then from loans and debentures. So here's our loan account. Balance brought down is going to belong on the credit, of course, alongside any proceeds from our loans. If we are, however, doing the opposite and repaying a loan, it is going to belong on the debit side. It is an expense, along with our balance carried down into the next period. Dividends paid then. So this time we're going to be focusing on the retained earnings account as opposed to the dividends paid account itself. So retained earnings, our balance brought down is always going to appear on the credit side with any profit or any loss that we make throughout the year. Whilst on the debit side, we are going to have our balance carried down into the next period. It is on this debit side that our dividends paid would belong in our retained earnings account.